Well, thanks everybody joining my podcast today. I have invited one of my friend Kelvin Kumar. He is with Aegon Financials. In this video, we're going to cover what are the options for retirement in Canada, right? So a lot of people they only know about TFSA, RESP, RSP. That's the level of knowledge and every person have when it comes to retirement savings. What we're going to cover in this video is to go through some other options as well that you probably don't know about it, pros and cons about that, and then this will be a multi-part series episode. So in this video we will only cover at the high level what are the options are. Next episode we will go further deep down into those options, and then we will be appreciating your comments and questions as well, because when you provide those questions we will cover those questions in the next episode as well. So feel free to engage with us, put your comments down below, and we will cover those items as well. So without further ado, let me introduce my friend Kelvin. How are you?
I'm doing great, Yasin. How's everything with you?
Everything's good, thanks for asking.
That's awesome. That's awesome.
Yeah. So, Calvin, before we jump into the agenda, why don't you just give us a very quick intro about yourself? What you have been doing at Aegon Financials, and how you are helping your clients in terms of achieving the financial freedom and financial independence.
Well, first and foremost, I want to say, of course, thank you so much, Yasin, for being able to allow me to hop on this call. So, of course, my name is Kelvin Kumar. I've been with Aegon and Transamerica for about 2 years now. Aegon is a well-known company, a credible company that's based out of the Netherlands. They were actually founded in 1844, and they've primarily operating in the European and Asian markets. When Aegon wanted to transition into North America, essentially they acquired or bought out a company that was called Transamerica. They bought them in the late 90s. So Transamerica themselves are a well-known investment and insurance company that's based out in the United States. So essentially, instead of bringing over their whole operations, they just bought out Transamerica, and we as advisors have been operating under Aegon's division of Transamerica since the late 1980s. Sorry. So being a part of this great company and being able to be a part of a great environment for that matter, to be able to go out there, help the middle market, wealthy people that aren't creating that much income, to be able to go out there and provide and those solutions and be able to get them to achieve those financial goals that I believe everybody is willing to go out there to achieve. So do want to say, of course, thank you so much for that, Yasin. And what we'll do today is we'll kind of jump into a few things here, and especially talking about something that's very important, which is going to be retirement and children education planning. Now, a lot of, and Yassine had mentioned this as well, is that a lot of Canadians are very aware of probably 3 to 4 accounts. This is going to be the RESP, the RRSP, and the TFSA. So we won't be touching too much on the TFSA today. I think that's a quite well-known topic. But what we'll do today is we'll talk a little bit more about the RRSP and the RESPs. So beginning with the retirement side on RRSP, this is a registered retirement savings plan. This is actually a government account. So what does that mean? This is something that you contribute to as an individual. Now, the great thing about an RRSP is that it has quite a few advantages. However, there are a few disadvantages along with that as well. First of which being, the advantages are that you're able to actually contribute to this account on a tax deductible basis. Now, well, what does that mean? Well, if we look at somebody who's earning income, of course, and we look at 18% of their previous annual income, that's going to be the threshold that you can put in. So technically, if you were to put it into terms, about 18% of your income from your previous year can now be tax deductible. Now, with that, and where the caveat lies, is that you're going to be having up to $31,000. It's a little bit over 31,000 actually. It's about $31,700. Or if you're making $175,000 a year, that's where your cutoff will be. So it'll either be 18% or $31,000, and it won't be able to exceed $31,000. So that's something that
Okay.
you always want to keep in mind and make a note of.
Yeah. Just to ask one question. So, could you also clarify for the audience, what is the difference between registered and non-registered account?
So a registered account is going to be something that you have with the government. So this is going to
Okay.
be going into your government accounts. This is something that you're going to be able to claim your income on. So what does that
Right.
mean? As opposed to a non-registered account, this is going to be something that, yes, you still will have to deduct and file taxes on, but a registered account is going to be something that is a government provided account, as opposed to something that's non-registered. This is going to be something for your own personal being.
Got it. Okay.
For sure, for sure. And now, along with that as well, when we talk about RRSPs, we also want to look at the positive sides of those tax deductible contributions. So, if somebody, for example, if they're making about $100,000 a year, great income, we want to be able to look at about how much they're actually able to take off on a tax deductible basis. This would be around $20,000 to $22,000. So, for example, if you're making $100,000 a year and you're deducting about 20 to 22,000, your taxable income is not going to be 100,000. You're now going to be taxed on between 78 and $80,000 a year.
Got it.
Great,
Yeah.
great fact about that is that you're able to reduce that taxable income and really have a lot of that money that you're earning be able to be then put away for your retirement later on. Now, with that being said, there are a couple negatives to this account or a couple
Yeah.
disadvantages for that matter.
Before you go into the negative side, I think one thing also I know is positive is this is this deductible, but when you reach your retirement age and when you draw that retirement account, you'll have to pay taxes. But the tax rate will be much lower than what you pay today because your salary is much higher today versus when you will be in the retirement age.
And that's exactly a big, big point. When people are nearing that retirement age or actually in retirement, people aren't earning the same amount of income that they will be earning. Now, when we are deducting those taxes now, we are going to be looking at later where our income is going to be dropping. Now, a lot of misconceptions that people have is, hey, I'm going to be taxed quite a bit. However, we also want to look at what we're actually going to be able to earn our annual income for that year. We're going to be earning a lot lower. So if we are making those withdrawals from our RRSPs, what happens is that your taxable income will actually be at a lower tax bracket because you haven't made that much income in that year. So this is where that misconception comes in, is that as opposed to maybe taking out a large lump sum, a lot of people that I work with, they start taking it out in smaller amounts over an extended period of time. And what that allows you to do is you don't increase that taxable income, but along with that as well is you're able to take out just the right amount to be able to ensure that you're not following into the next tax bracket and allowing yourself to, potentially pay more taxes than you will have to. So that's definitely a big, big caveat with that as well. Now, RSPs are also great, but a lot of people are also misinformed about what they're actually doing with their employer. Now, when we look at an employer standpoint, we also want to look at what the employer is providing to you as an employee. So a lot of companies really depends on the company. Of course, this is something that you can also ask your employer with, but a lot of companies do something called an employer matching. So you have an employer matched contribution. Now, this is going to be something similar to a pension, similar to something that's going to be able to keep you there. These are things that a lot of employers put into the picture to not only incentivize their employees, but along with that as well is to be able to ensure that their retirement and their later years are covered through the hard work and service that they've done throughout those years. Now, with that being said, when we look at some of these employer matched, it can really depend, right? I've seen 4%, 6%, even up to 8% before. So that's definitely quite a bit of your employer being able to match what you're going to be able to have. Now, it can be ratioed out from a percentage standpoint. It could be a dollar standpoint. That's just something that varies on a case by case basis, and this is something that I would recommend all the viewers to be able to go in and speak with your employer with. Now, with
Yeah.
that being said,
Just one
yeah.
just one question to ask. Can a person have those two accounts in parallel, or can they merge together to have a big pool of account where the employer is also matching and they can also contribute into it?
Yes. So what would happen
Yeah.
is you would have your own RSP contribution. This would can go directly to your own RSP for that matter, right? This is something
Okay.
you can have as well. And then your employer match, this is going to actually be a different account later on down the road. So what would
Right.
happen is when you have something like an employer contribution, we want to also look at what would happen down the road. So let's say, you've been working for 20, 30, 40 years. What would happen with an RRSP is that you have something called an RRIF, which is a registered retirement income fund. So by the age of 71, your RRSP must be turned into an RRIF. Now, when you have something like a contribution or a pension plan, that would be falling under the bracket of a LIRA or an LIRA. Now, the thing is with the LIRA is that this is going to be income. This is not an individual contribution, by the way. This is going to be something that your employer matches. So, what a lot of people have the misconception with is that, hey, can I put more into my LIRA or put more into my pension plan? Well, no, this is going to be something that your employer is going to be able to contribute for you. Now, with that being said, along with that as well, is we want to look at what a LIRA actually does. Now, a LIRA is a locked-in retirement account. Essentially, what that is these are funds that you cannot access until you've hit that age of retirement. Now, why is this and why is this very important? Is because not only are you not contributing to that, but along with that as well, it provides you the safety and security of having those funds, knowing that when you're hitting that retirement age, all those years of service that you've put in, and your employer also matching you, can be put into that account. And what would happen is now you can have a steady stream of income, just like an RRSP, and be able to take out those funds. Now, along with an RRSP, that is also a tax event. That can be a tax.
Okay. And is LIRA an independent from the RRSP account?
Yes, that is correct.
Okay.
So a LIRA is something that you're not going to be able to contribute to. This is going to be something that you're.
Okay. It's going to be totally funded by the employer. You will not have any access or any contribution into it. Okay.
That is correct. Now, also with the LIRA is similar to how an RRSP has to change into an RRIF. A LIRA also does have to change at the age of 71. This turns into something called an LIF or a LIF, which is a life income fund, or it can be also transitioned into something called a life annuity. So these are the two options that a lot of people are going to be taking, especially when I'm dealing with a lot of my clients that are nearing retirement or already in retirement and they're in that stage of how they want to be able to transfer. These are going to be some very important things. Right now, these plans also have something where we want to also look at as well. So first is going to be a defined contribution pension plan or a defined a benefit pension plan. So it's the way we want to set this up is a pension plan is obviously great. You know, you're able to get that money from your employer. However, there are some differences in between that. Now, what we want to look at is the DBPP, defined benefit pension plan. For those funds to be able to be transitioned into a LIRA, you actually have to do something called commuting your pension. So essentially what that is you actually cash out the money from that pension plan and then you can transfer it into a LIRA.
Okay. Just to take a pause on that. So basically, you covered three different accounts, right? So you covered RESP, you covered LIRA, and now you're covering the defined pension
Yeah.
plan.
And
Uh,
how those plans are going to be working and what the taxable events and how those
yeah.
funds will actually be transferred into a LIRA are going to be
Yeah.
very important as well. So there's going to
Okay.
be about two ways for that.
So just for people to just be on the same page, could you just quickly summarize the differences between the two? Because I think an ordinary person may not have the understanding of all these accounts.
For sure. So DBPP, this is going to be something from your employer, right? Now, along with that as well as a defined contribution pension plan, this is also going to be from your employer, but the way they set it up. So this is dependent on your company. So this is going to be from your employer. They either have something called the defined benefit pension plan or defined contribution pension plan. So these are going to be the pension plans that you have with your company. Now,
Mhm.
the way they work and the way those can potentially be altered is the first with the defined benefit pension plan is that these funds that you're going to be using for retirement for your pension plan, they're going to have to be commuted. The word is called commuted. Essentially, what that means is you have to cash out those funds. Now, you're taking it from a defined benefit pension plan, and essentially, what you're going to do is you're going to cash it out, and now you can transfer it into something like a LIRA. However, with
And when you do that, is it at the retirement age?
yes, that is correct.
Okay. So that will be a taxable event, right? So when you cash out, so you will be liable for paying taxes on that,
Well,
I believe.
you can cash it out. Now, the thing is, that is actually not a taxable event because now the income is not yours. You could technically use that. If you do have that money, that could be a taxable event. Now, this is where
Okay.
something like a defined contribution plan comes in. Whereas that
Hmm.
with a defined contribution pension plan or a DCPP, you can essentially just transfer that straight to a LIRA right away. You don't have to cash out those funds. Now, with
Okay.
that taxable event keeping in mind, when we look at something like a LIRA, we want to look at, okay, I have a LIRA now, I have this account set up, and this is a very uncommon account. Not a lot of people actually even know they have something set up similar to a LIRA with their pension plans because it's not talked about a lot. a lot of people are very aware and active about their RSPs. They want to be able to know what the growth is, what they're actually getting. But something like a LIRA, this is going to be from your employer side. So not a lot of people not only have the understanding of not knowing, but they also have
Yeah.
that where they aren't even sure, right? So this is something that you always want to be able to take a look at what your pension plan is, what you're actually going to be getting from your employer, and then
Yeah.
also be looking at either if it's a DBPP or a DCPP. And either
I think not everyone has an opportunity to have these accounts, right? Because it depends upon your employment contract. Some companies only offer RRSP contribution, but not the defined, pension plan or LIRA, as you mentioned. So it really depends upon your contract. So I think it's worth checking with your HR or your payroll department just to have a better understanding in terms of, okay, what level of retirement contributions that you have from the employer. It may vary from company to company.
definitely. And that is one of the biggest caveats. And what I always recommend a lot of people that are, starting to plan out their retirement, I always say planning out earlier the better. Right now, why is that?
Absolutely.
When we have a longer time horizon, we have fluctuations in the marketplace. We have these ups and downs in the marketplace. But what we can always almost guarantee is that the market historically has always gone up. And if we look at a longer time horizon, 10, 20, 30-year time horizon, that allows us to have quite a few fluctuations and quite a few bridges and gaps that we're going to be able to have that growth, right? When we look at the valleys and the troughs, we are continuing to have that. That's always going to be prevalent. And we, as advisors, we can only do so much to be able to help out our companies that we work with to be able to provide that safety and security for our clients. Now, with that being said, we always want to look at the time horizon that we're working with, right? Now, when we also look at somebody who's now in retirement, everybody who's an employer or employed for that matter, um, this is very common, is going to be CPP, which is Canada Pension Plan. So this is something that you will receive from your government, and this is something that you also are paying out of your taxable income into. So along with that as well is that this is something that you would be able to receive once you hit that retirement age. On average, you're going to be earning around $1,200. Your most that you can receive is just shy of $1,400. So that does change on a year-to-year basis. As of April 2024, it was just under $1,400. I believe it was $1,374. So that's something that you're going to be able to receive from the Canadian government.
That's the monthly amount, right?
Yeah, that is
Okay.
correct. So this
Okay.
would be on a monthly amount. Now, why is this very important? Why do I mention something like a CPP? Well, in today's day and age, I always ask people: is $1,200 a month going to be able to, provide you that income?
Absolutely not.
Are you going to be able to live off that income? And
Yeah. You,
as
you
you
can
said,
you can barely afford groceries in that amount.
and if you have
Yeah.
children, if you have rent, you have a mortgage, maybe for that matter, that's not going to be able to get you to those goals, right? And this is where we come in as well as advisors. We want to be able to set up our clients with these accounts, not only from the employer side and making sure that's also taken a look at, but also contributing to something like an RRSP. Now, along with that as well, is that we help people fill that gap. We want to be able to make sure that okay, they understand what they're working with, right? And this is very important because that monthly CPP they're going to be getting from the government, are you currently leveraging, assets? Are you leveraging anything else that you're using towards retirement? And this is where we love to come in and show those vehicles that can potentially better somebody's retirement, right? So being able to first understand all these types of options is going to be very, very important, right? Now, are you aware? And this is for the viewers. Are you aware by saving something small can compound into something massive over a 10, 20, 30-year timeline? And the answer is almost always yes.
Yeah. Just to mention something here. So I recently ran a survey on my YouTube channel, and the question was, okay, what are your retirement plans? And I think 27% of them responded they have no idea, like they haven't done anything about their retirement. Some said okay, they're contributing into mutual funds and ETFs and stocks and bonds. Some said they are working on their crypto portfolio. Some said they're building a real estate portfolio. but 27% of them said they haven't done anything, which was a bit shocking for me, because any professional who is working right now or in a working age must have a retirement plan, because you are going to get older and you're going to get retired at some point, and you should and must be planning for it, because time will fly, and you'll be struggling to meet your expenses if you haven't done anything yet.
Definitely. And I mean, we aren't getting any younger,
Yeah.
right? So we always want to make sure that we're starting to save early and we're starting to save often, even if it be, $30 a week, $20 a week. I always look at a lot of not only advisors that I also work with, but also we're working on a case study with some of our clients. Some clients, and one of the advisors that actually used to work with Transamerica, he had started, I actually heard on his podcast, he started saving at the age of 21. Now, he's of course in the States as well, but we want to also look at, what they're being able to contribute. And early and often is always the best result, even if it be a small amount, because this is always what people have the misconception of when it comes to not only saving for retirement, but also being able to invest or be able to allocate funds. Is people always have this misconception that it's the amount that you save or how much you're actually putting in. I don't necessarily agree with that. It's how often you're saving, how early you're saving, and where you're actually saving those funds and allocating those funds to put in work. The example I like to give is, let's say we think of something like a retirement account, like going to the grocery store. Now, if I go to the grocery store and I didn't buy anything, and I come back to my fridge and I open up my fridge and there's no food there, well, I didn't buy anything. So how do I expect my fridge to be full? And what does that mean? And where that lies and where that anomaly is that we need to be able to purchase assets that are going to be compounding, going to be growing. We always want to look at consistency as well from these funds. So something like an S&P 500 or following an index to begin off, ETFs. These are great ways for beginners to be able to get some of that exposure to the marketplace. And along with that as well as also understanding your time horizon, right? And this is where something like an RRSP, where you're able to, have not only passive management from a financial institute, you can also have personal management, which is going to be yourself, or you can have active management as well, who's somebody managing your money and they'll be taking a small fee.
If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy, and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later. Absolutely. And I think I always mention in my videos as well, in terms of, um, you don't have to be a super rich to start investing now, right? You can be an ordinary person. Saving $1,000 a month should be good enough for you to start investing. All you need is two things: discipline and consistency. If you're consistently, contributing $1,000 a month for at least 10 or 15 years, you can easily double your money. Easily. Yeah.
Exactly. And we want to look at, and something I want to do is something I actually learned this from one of the advisors. He used to work in this industry. His name is Ed Milet. Now he's, of course, a great speaker and a great mentor, and he's in the podcasting space a lot as well. And a big thing he used to, say in his podcast is, see what your most ideal year would be. You're not working, maybe you are working, maybe you're with the kids, traveling, exploring new places, eating good food, wearing the clothes that you want to wear. We want to look at this most ideal kind of year.
Yeah.
right? Now, this most ideal year, get that number and divide it by 0.04 or 0.05. Now, what does that mean? Well, if you're nominally earning about 5% interest, which is a very nominal rate by the
Yeah, that's commonly called the 4% rule, right? So, uh, yeah,
if we use the 4% rule, this is how much you can look at how much you will actually need for retirement. Now, just some stats from I got from Stats Canada is that most Canadians need a staggering $1.7 million to retire, which is shocking
yeah,
in today's day and age where the inflation rate is always very high, where we also want to look at the cost of living, cost of certain other things as well. We want to be able to allocate those funds not only in the right place, saving early, saving often, and as you had also mentioned, Yasin, the discipline and consistency. Because this is the two most important things when it comes to saving. It's not how much you save, it's the discipline of saving and the consistency of it. If I go to the gym one time, I'm not going to be, having the shredded six pack. I
absolutely
wish I
not.
did. Unfortunately, that's the reality. We want to be able to put in that work.
Yeah,
Same thing with investing, same thing for working towards retirement. We want to look at that longer time horizon. If I'm even able to save, let's say $20 a week or $20 a month for that matter, we start letting compounding interest do the work. And I recommend for all viewers to not only do that 4% rule, but also look at how much of a difference something like that can make. The consistency of saving early makes the biggest impact. We
yeah.
actually had a client, we had two clients actually, and they were both friends. They were really good friends. One of the friends, he had put in a nominal amount. I believe it was about $100 or $200. I can't remember. I think it was $200 a month, and he put that consistently over, I believe, 20 to 25 years. Now, altogether, I believe he had about 300,000. It was about 280 to $300,000. There were some months where he saved a little bit more, some months he saved a little bit less, but on average, it was about 150 to $200 a month. Now, when he put in about 200 to 300,000, his friend, ironically, saw what he was doing and also wanted to kind of get into the action, right? He's looking at his friend, he's saving this money, being very disciplined, having the consistency of doing that. He also started saving. However, since he started about 10 to 15 years later, he didn't allow something called compound interest to come into work. So even though he put in, I believe it was $400 a month, he actually had only about 200,000 to 300,000 after, whereas friend one, who's starting early and started often, they had over $1 million in that account. Now, over
Yeah,
that 10, 20, 30-year timeline, they didn't put in any more money. They both put in about two to $300,000 into
yeah.
retirement.
It's a
It's the
time.
time horizon.
Yeah,
Exactly. And
absolutely.
that's where we also want to come into that, right? But
Yeah.
also coming back into the retirement side as well, we've talked about CPP. Let's also talk about a couple other accounts that are very, very important. One is going to be OAS, which is old age security. This is something that you also receive after the age of 65.
Is this also government funded?
Also a government account. So it can be around $500 a month.
Okay.
Essentially, what it is the requirement for is you must be in Canada for 10 years after the age of 18.
Okay. And is this cumulative or you can be in and out?
This is something that you can apply for.
Okay.
This is something that you can simply apply for from the government. This is old age security. It's around $500 a month. I actually know some of my older family members as well. I've been able to help them out. God bless, with the grace of God, be able to kind of set up these accounts and be able to get that money for them and be able to have access to those resources that we have possible. But along with that as well, it's also a very important account where a lot of when we look at it, something like a CPP, people think, okay, why are my taxes getting cut? Well, I'm paying it for people that are a little bit more elderly. However, we also want to note that whatever you put in now, you're also going to be able to get back later.
Yeah.
So don't sweat it on the CPP too much
Yeah.
because it's always going to be able to rebound back, and you're going to be able to get that as well.
Hopefully.
So that's definitely important.
Yeah.
And one last account I do want to talk about is going to be GIS. So CPP, OAS, and now GIS, they all kind of work in a trio, right? So similarly to how RRSPs and a LIRA kind of work in a duo, this is going to be kind of that trio. So, GIS is something called a guaranteed income supplement. Now, this is something that you receive. I do have the stats here, so I'm going to quickly take a look at that. If you're earning under, so this is just in context, guaranteed income supplement is something to also supplement your income under these conditions, right? So if you're under $21,000 on an annual income, and you're at the age of retirement, you're able to qualify for GIS. Now, if you're under $28,000 and if your spouse also receives OAS, then you're eligible for GIS.
Right.
If you're under 52,000 and do not receive OAS, then you can also apply for GIS as well. And if you're under 40,000 with your spouse, then you can also get OAS as well. So these are going to be the limiting factors. This is also something that we can also see on the Revenue Canada
Yeah.
website. But those accounts always work in unison, and CPP is something that these are government accounts.
Right.
These are federal government accounts. So we always want to make sure that we also not only talking about the investing side, but also what's out there in terms
Yeah.
of.
But I think the difference between CPP, OAS, and GIS is in CPP you have to contribute from your salary, but OAS and GIS you don't have to contribute, right?
You don't have to contribute.
Okay.
So this is going to be something from the taxpayer dollars that we're putting into taxes. This is always going to be pooled into that fund,
Yeah.
and these are some of those income supplements that we're also able to
Right.
receive from the federal government.
And for OAS, you mentioned you have to be in Canada for 10 years at least. Uh, do they have to be working in those 10 years? Is that the condition as well?
So as well, let's say for example, you lived in Canada for 5 years, and then you left the country. Let's say you went to, I don't know. Let's say you went to England. Just a random country I can think of, right? And you went to England for about 15 years, and you came back, and you spent another 5 years here. Yes, you would now be eligible.
Yeah.
The other eligibility factor as well is that you have to be working in Canada 6 months prior to your retirement age.
Okay.
So that's going to be very important as well, is that they want to be able to ensure that you're going to be in Canada for at least 6 months prior to that, so they can always allow you to have that eligibility as well.
Yeah.
I've seen some people that
It's,
they're nearing that age of retirement,
yeah.
and they haven't hit that 10-year mark. Honestly, what I recommend people is maybe even just some sort of employment. Now, I don't recommend that always. When you're in your retiring years, you always want to be able to do that and enjoy and the fruits of your labor. But if you want to be able to get OAS, these are some of the factors that you want to be able to
Yeah.
consider.
Sorry for the interruption, guys. Just wanted to let you know that we have a team of realtors which is covering the entire GTA as well as some outside areas as well, like Brant region where I am based off, and I help out the clients in this region as well. So if you have any needs with regards to real estate transactions, buying, selling, investing, renting, let me know. There is a link down there where you can book a one-to-one consulting call with me, and we will be more than happy to help you out. Let's get back to the video. The reason I asked was a lot of women's, because of the family commitment, kids, they don't typically work, or even if they work only part time, right? So for I think those, I mean, for men there is of course no choice, right? They have to work, but for women's, I think some of the women's they don't work at all completely, right? So for them, in order to access OAS, you're saying that they should be working at least the 6 months before the age of retirement. Is that correct?
Theoretically,
Yeah.
yes. Now, even if they've been in Canada for 10 plus years since the age of 18, that can also be something that to keep in mind.
Okay.
So let's say theoretically, you were a Canadian citizen, you left the country, you came back. As long as you're here for 10 years plus during that time,
Hmm.
from age 18 onwards, you're definitely eligible for that.
Okay.
So that's something to always keep in mind as well. It's not like CPP where you kind of have to contribute to it from your taxes. This is something that is also going to be federally funded.
Okay. Okay. One question that I wanted to ask was, how do we? So this is all good information. Thanks for sharing, Calvin. We also are aware that inflation is another issue that Canadians are facing. We haven't faced this in the last 40 years, and the Canadian currency is also losing its value compared to US dollar or other international currencies. How do we hedge against that? Can we have any of those accounts um, you know denominated in US dollar somehow, so that we can have some sort of a protection against currency fluctuation?
For sure, for sure. When we look at something like the foreign exchange rate, we also want to look at essentially where we're investing our money as well. Now, there are Canadian ETFs that are following U.S. stocks like the S&P
Yeah.
500. For legal purposes, I'm not going to be saying some of these ETFs, but you can definitely find out funds that are out there that you can also have in Canadian dollars. Now, I know for a fact, when I started my investing journey earlier on in my early 20s, late teens, I was able to actually convert money from my Canadian dollar into US dollars. Now, with that being said, there are some tax implications that we want to keep in mind of. One, and I believe the most important, is going to be dividend income. Now, this is very important. I love dividends. It's of course, if you don't know what a dividend is, it's the profit of the company. They tend to share it out with their shareholders. Dividends are a great way to be able to earn that extra income along with appreciation. Dividend paying stocks are wonderful, but when we're looking at U.S. based stocks, funds, ETFs, mutual funds, things like that, we want to look at what the dividend rate is. Now, the reason why I say that and why that's very important is you have a 15% withheld tax on dividends. So, what does that mean? If you have a TFSA, for example, and you're investing into U.S. stocks, your capital gain is not taxable. However, the dividend income is.
Okay. I did not know that. Even in TFSA, you have to pay tax on your dividend income.
So the IRS on dividend income that's what they're going to be taxing. It's about 15%.
Okay.
Now the capital gain, that's actually not taxed.
Right.
So that's something that we always want to keep in mind. Similarly, if we look at the United States market, something like a Roth IRA, they treat a Roth IRA very similar to how we treat our
Right.
RRSPs. So same kind of thing, or an IRA for that matter, right? So 401ks, 403bs, all that type of stuff. So we want to look at kind of what the comparison is,
Yeah.
right? Now, when we look at dividend income in specific, there is a 15% withheld
Yeah.
withheld.
And what about if we invest into Canadian ETFs, dividend paying stocks?
You're fine. You're totally
Then
fine.
you don't have to pay those 15% withholding tax. Okay.
No tax.
So I think this is a good decision point between investing into Canadian-based ETFs versus US-based ETFs. If you're only targeting high dividend-paying stocks, I think you should be investing into Canadian ones because that way you can save money in terms of the taxes on dividend versus the US ones.
And especially investing in something like a TFSA where you have a little bit of that flexibility in terms of your capital
Yeah,
gains. It's a great account, and I always recommend everybody contribute into TFSA or allocate those funds in the right manner, and we can always be able to have something like that with Aegon, with Transamerica, to be able to do that research for you
yeah,
and be able to see how we can help you out with it. So
absolutely.
that's always something to keep in mind as well. But along with that as well is I think this is a great leeway to also look into what we're going to be looking at for our children, because we've talked a little bit about retirement, but we're working hard. We've built a life for ourselves, but we also want to look at the life that we're going to be building for our children, right? Children are, of course, a big part of our lives, right? We want to be able to ensure as parents, as adults, that we can actually set them up in the right manner. And a lot of people are very familiar with something like an RESP. So, a lot of people love RESPs. It's a great account, it's a registered account from the government. But we want to look at essentially what the RESP offers to you. Now, RESPs are very important to look at in terms of province to province, especially here in Canada, because there are some grants, things like that you're going to be getting. So let's take a look at a little bit of a deeper dive into this. Now, first thing that we get is called a child tax benefit. I believe it's called CCB now. I forgot what the acronym for it is now. Canada Child Benefit, I believe it is now. Essentially, what that is per child you will receive a benefit from the government. Now, this is of course to be able to supplement young children growing up. You receive a child benefit. Now, this varies and it depends on one thing, which is going to be your household or family income. Now, on average, you would be earning about $200 to $700. These are the average numbers, but this is also something that you can take a look on the CRA website and see how you would qualify and what amount you'd be getting.
Yeah.
So this is something, and it varies case by case as well. Now, the second grant or second thing that you'd be receiving from the government is something called a learning bond grant. Now, essentially, what the learning bond grant is that you get about, it's basically a tax-free payment um, from the government between the ages of 6 to 8. So the from the age of 6 to the day before your child actually turns 9 years old, you can get a Canada Learning Bond from the government as well, and that's going to be something that you're able to kind of take a look at. Usually, it's around $500.
Okay. And this is the bond issued by Canadian government, federal government. Okay.
The CLB. I like to give acronyms for everything, of course. So
Yeah.
CLB. So first thing you want to look at CLB. You want to look at what you're actually getting from the provincial government. Last one is going to be your provincial grant. So this is a one-time payment. I believe this is also from the ages of 6 to 9. This is essentially what the learning bond is, the provincial grant. In BC here, and I believe also in Saskatchewan, it was about $1,200. So they're both one time. So the learning bond and the provincial grant, these are one time grants. You have to apply for these. So go on your local provincial government website, see if your child is eligible for that, and go ahead and apply. I don't like to use the word free money, but it is essentially, taxpayer dollars that we're going to be able to use towards supplementing something like that.
Right.
Now, the last thing is going to be your grants from the government. Now, what does this mean? Is that out of every dollar that you put into your RESP, the government will match, they won't match it, but they'll also contribute 20 cents. But yeah, so we want to also look at something like, your grant amount, right? So the provincial grant, or your contribution, that is going to be up to, I believe, about $7,400. So we also want to look at that as well. RESP in
And
full,
that's
I
also one
believe
time.
this is going to be 20% match. So
Okay.
I believe they do it on a monthly basis. Um, so with the RESP, I believe your limit is about $50,000.
Okay.
Now, 50,000. If we want our children to maybe do 1, 2, maybe 3 years of education, we can definitely supplement that income. However, when we start looking at later down the road, your child's performing really well in their undergrad, and they want to be able to go to med school or go to law school, right, or pursue that postgraduate education. We may not be able to supplement that. Now, one thing to note, and these are very, very important factors about the RESP. It is a great account. However, there are, similar to an RRSP, there are a few drawbacks. First is going to be that it's actually taxable to the child.
Okay.
What does that mean? Well, your children, especially when they're growing up, they aren't making, they're going to be working, entry level jobs, somewhere along those lines, right? I don't expect a 19-year-old to be a director or a CEO. I mean, I hope so. I hope, but
Yeah.
most like more than likely that's probably not going to happen, right? So they'll be earning that income, and when they're around that 18, 19-year-old age, they want to be able to do some things. They want to be able to go out with friends and have those lunches and buying food and all of these things, right? So we want to look at some of those things as well. See, what I like to think about it is that since it is taxable to the child now, they're gonna have something called a little bit of a debt start. DEBT, debt start. Why is that? Is because when you look at it, now they're getting taxed. Now they're paying that tax. They're going to be, putting that in. At the end of the day, it is not taxable to them, right? So this is something that we want to keep in mind as well. Is that this is going to be very important when we're looking at some of these things, right? So that's going to be the first thing. Second thing we also want to look at is going to be what it actually does. See, when we have an RESP, the one caveat is that can only be used for education. So a child, maybe after they graduate, maybe they want to buy that first car. Maybe they want to potentially purchase a home later on down the road. Maybe they want to get married,
Mm,
right? These are new business, family, vacation. You know, what they're going to do to purchase these things is they're going to start having debt.
yeah.
This is why I call something like this a debt start. Now, why do I say debt start? Is because RESP can only be used for one thing, only education funds that you can use for your child's future education.
So you cannot use RESP for anything else other than education fund.
So that is the one thing similar to an RRSP or a
Mm,
LIRA for that matter, for better lack of words, is that this can only be used for education.
right.
Now, these funds are not used for education. You do, and how essentially how an RESP works is you would essentially pay it up front. So you would go get the receipt of admission from your university or your college, and then you can go and access those funds with your financial
Okay.
institution. Those are going to be those things as well you want to look at.
Right.
Now, why I mentioned that is because this is very important, especially in today's day and age where we don't want to have low hanging fruit, right? When we have a child actually set up, I've actually seen this. I was speaking to a young family. They have I believe the child is about a year and a half now. This is about 6 months ago. So the child is about a year old. I believe it was just around their birthday. The parents were telling me that right when the child was born, a week or two later, they actually got a call from the provincial government saying, hey, we should set you up with your children's RESP. This is going to be a fantastic account. It is a great account. However, we also want to look at the implications in terms of what the actual account is. And this is where education comes into the importance of it. So it's very, very important.
Mm,
If we set ourselves up with an RESP, amazing. Similarly to that example that I gave about, looking into the fridge, putting money into that, that's great, but we also want to look at where those funds are allocated. How much am I going to be able to have later down the road?
yeah.
And also understanding that it is going to now be taxable to the child. So that is also going to be a very, very, very important topic to also
Yeah,
discuss.
absolutely. I think we have to touch upon these tax implications in the next episode because I know that this is a very complex topic and we cannot just summarize everything in this video. So, for folks watching right now, please stay tuned because we're going to touch upon all of these topics in more detail in the next episodes, especially when it comes to tax implications, whenever you choose these options. Um, so I think we are approaching the time here, Calvin. So I think this is very interesting. A lot of information that you shared. Thanks very much for that. I truly hope that the audience will find it very useful because I know that personally because when I talk to a lot of people, they have no idea about these options beyond RESP and RRSP. So when they consume this content, then I think this will open their minds in terms of how they can properly plan for their future, especially with regards to retirement, as well as the kids' education and non-educational events like marriage, business, whatever. So, any last thoughts, Calvin, you want to share?
I think we had a great talk today. Being able to provide that education to our viewers is going to be very, very important. Being able to digest, and I know we went very high level in terms of the accounts and kind of what they do, but I definitely, appreciate you, Yasin, for being able to have me allowed to join on this call today. I definitely think that our viewers are going to get a lot of valuable insight. I definitely think on our next episode we'll be able to kind of dive in a little bit deeper, be able to go into a little bit more higher level, and then we can also maybe discuss some options and strategies. I think that would be beneficial for everybody as well with that.
Absolutely, absolutely. Thanks for your time, Calvin. And for folks who are watching, please reach out to ourselves. So there is an email address in my description below. Reach out to us, share your requirements and what you're trying to achieve from a financial goals perspective. I will connect you with Calvin, and we can give you the best and honest advice possible based upon your own circumstances and your financial goals. And hopefully, you will see the benefit. When you reach that retirement goal at some point. So thanks very much, Calvin. We'll see you next time. Are you a non-US tax resident and looking to open a business in the US? Well, this video is very important for you, so watch it till the end. Basically, if you are a non-US tax resident, which means you don't have SSN, which is your tax identification number, which means when you open a bank account or you open a Stripe account or PayPal account or Amazon business account or any business account, you need your SSN number in order to open any of these accounts in the US. While if you are a non-US tax resident, which means you don't have SSN with you, you can have another identification which is called ITIN. So ITIN is similar 9-digit number which is used for tax purposes if you are a non-US tax resident. So whenever you apply for a business account or bank account or payment processing account like PayPal or Stripe or even Amazon FBA seller, or registering a business in the US, you can use ITIN instead of SSN. This will help you to set up all of these things even though you're not a US tax resident. So if you're in Canada, Latin America, Europe, UK, Australia, or anywhere in the world, you can apply for ITIN, and you can use ITIN to register a business, open up the business accounts, open up the payment processing account in the US, and pretty much do all the tax related stuff using ITIN, even though you don't have SSN. So how do you get that? Well, there are some companies available on the internet that will help you to get you the ITIN, but they may charge between $400 to $600 per application. We have a company called ITIN, and they are one of the quickest in terms of submitting the application. So they will help you out in terms of collecting the documentation, help you out in terms of answering your questions, and help you out in terms of submitting the application. Now, the typical application process times takes between 4 to 14 weeks, but the ITIN people only take 48 hours to collect the information, help you out in the journey, submit your application, and from that point onwards, it's basically IRS. IRS can take between 2 to 12 weeks depending upon their volume of the applications, but throughout the process, they will handhold you in terms of opening up the accounts, help you to open up the FBA account or Stripe account or PayPal account, or guide you in terms of the entire process. They're pretty quick to respond. They have people speaking English and Spanish and Arabic, and they can give you very competitive rates as well. Plus, if you use my referral link, which will give you extra $50 discount when you purchase their services. So if you are looking to open a business in the US, start your journey today, apply for ITIN. Even though if you're not looking to open a business now, you should have ITIN just in case in the future, if you want to open a business, you're ready from tax standpoint. So check the link in the description below, and let's get back to the video.